If you're going to be a successful investor, at some point you're going to have to learn how to apply financial ratios into the analysis that you do of either the companies or the ETFs that you own. In this video today, we're going to look at one of the most common ratios, the price to earnings ratio. And this is something that every investor has heard about. It's commonly referred to as a PE ratio. In the video today, we're going to look at what a PE ratio is. We're going to look at the advantages and the disadvantages that it can give to us. We're going to look at what I call the three misses, the mistakes that investors make, the misinterpretations, and the misunderstandings of what a ratio like this can do for you. I hope you stick around for this video.
Ain't a cloud in the sky, ain't a worry in my mind. Looks like we're in the clear, just living the life.
Before I get into the meat of the video today, I will be using quite a few charts and graphs to try and explain the concepts and give you some examples of how you would or wouldn't use the price to earnings ratio. The platform that we use at the Investing Academy is Koyfin. That's our go-to charting platform. You're going to see a lot of examples of their charting capabilities and their research capabilities today. We've recently struck up an affiliation with Koyfin, and in the description below, I will put a link. If you're interested in learning more about the platform itself, they do have free versions, they do have paid versions of their charting capabilities. Feel free to click on that below. Also, speaking of the Investing Academy, the first link down below will be a link to our Investing Academy if you want to learn more about that. Lastly, this is going to be the first in a series of financial ratios videos. I believe that to be a successful investor, you really do need to know how to apply these metrics to the evaluations you're doing of a company. Price to earnings is going to be today. The next video I'm going to do is either going to be sort of the sister to the PE ratio, which is the PEG ratio, the price to earnings to growth ratio. It's sort of an enhanced version of the price to earnings, or price to book, another very valuable metric that you will probably want to use in your evaluations. I'm going to take my lead from you. Drop a comment below. Let me know whether you'd prefer the PEG ratio, price earnings to growth, or whether you'd prefer the price to book for my next video. And I will, or my next video on ratios, and I will take that into account. I'll look through, and whatever is the most highly voted, that's what I'm going to go to. But let's get started with the price to earnings. So first of all, let's look at what the PE ratio is. It is one of the most popular, most widely used ratios that does provide a rule of thumb to determine whether a company you're interested in is either overvalued or undervalued. Generally speaking, if a company has a low PE ratio, it's thought to believe that the company is undervalued. Conversely, if a company has a high PE ratio, it's thought to believe that that company may be overvalued. But of course, it's not that simple. There's a lot of things we have to factor in. Let's cover those off right now. First, I'll just ask a question. If you have two companies, so these companies make widgets, and I'm going to call company A Widget Co. A, and it trades currently at $10 a share, or you have a company called Widget Co. B, which trades at $50 per share. If I ask the simple question, which one of those is cheaper, not from a dollar perspective, but a cheaper company to buy, a lot of people are just going to default to that 10 versus 50 and say, well, I would rather buy the $10 share. It's obviously cheaper than the $50 share. Of course, it's not quite that simple. A price to earnings ratio is what's called a relative valuation. So it measures the current share price against the relative earnings that that company makes. So that the share price in and of itself doesn't tell much of a picture. You have to look at what you're willing to pay and what the profits or what the earnings are from that company to make a proper evaluation. If a company has a PE ratio of 15, that basically means that an investor is willing to pay $15 for $1 worth of earnings. Another way that investors commonly describe this ratio is if you paid $15 a share for a company that's earning $1 per share profit, it would take 15 years of those earnings to get your money back. So $1 a year for 15 years would come back to your $15 share price. Now, obviously, you wouldn't expect a company to be stagnant for 15 years without increased earnings, but that's a simple way of just sort of putting inside your head how we can value, or how you place a value on a multiple or a price to earnings ratio. Going back to the example of the two widget companies I just said a minute ago, let's take a little bit deeper dive to help understand this concept in a little more clarity. If widget company A, as I mentioned, is trading at $10 a share, if they have $1 of earnings per share, then you simply take that formula, divide $10 by 1, and you have a PE ratio of 10. Now, Widget Co. Company B, this was trading, remember, at $50 a share, but they earned $6 per share in earnings. So if you take your $50 share price, you divide it by earnings or EPS of $6, you're going to come up with a PE ratio of 8.33. Looking at this simple math example, 8.33 obviously is less than 10. So you're going to be able to say roughly that B is a cheaper investment, a cheaper company. If all else is equal, then that would give you that would be a good application of the price to earnings ratio. But again, as I said, it's never that simple. Going back to the actual formula itself, using Pepsi as the example, we can see that they're currently trading at a share price of $155.43. Their last reported earnings per share is $5.94 per share. So if you simply take the 155, you divide it by the 594, you're going to come up with 26.2 as the current price to earnings ratio. So when you're looking at how to do the calculation, it seems really simple. You take your share price, you divide it by the EPS, and you have your EPS. It's really not quite as straightforward as that. Main reason being is there are two different types of periods that you can use when you're looking at the earnings. There's called trailing earnings, and there's called forward earnings. So in trailing earnings, you're going to often hear or see the acronym TTM, which is the trailing 12 months. Koifin, the charting I'm using here, uses last 12 months in this case. So they all mean basically from the most recent reporting period and before that. You're also going to commonly see and apply what are called forward earnings, so the next 12 months. And often this can give you a better or quite a different picture, and we'll look at some examples today of how if you look at the earnings that are expected to occur versus the earnings that have actually occurred. Neither of those are perfect. In the previous trailing numbers, the previous reported numbers, of course, we all know that there are accounting shenanigans, I would say, but there are ways that companies can make the books in a period look better, following the laws, following the rules, but without digging deep into a financial statement, you might be misled as to what those actual numbers are. That can skew the PE a little bit. Or going forward, you're relying on guidance from the company, you're relying on analyst expectations or your own calculations that show from this point on, what do we expect the earnings to be? And that's the number that would be used going into the calculations and to create the EPS number or the PE number. Going back to our Pepsi example and using the price to earnings ratios on the charting here, we're going to look at, we just calculated the current ratio of 26.2, 26.3. You'll notice the LTM beside the PE, and that means last 12 months. So this is what I was talking about, the trailing. So this is based on the income previous months. I've also overlaid now the next 12 months or the forward PE, and we'll notice that PE ratio is now 24.3. So it's lower than the trailing 12 months, and this is quite common that you're going to see a discrepancy between these two numbers. I'm going to just now add the earnings per share estimates. So this is what the next 12 months is being calculated on. And the analysts are expecting that the earnings per share are going to go from 5.94 today up to 6.41. So when you do the math on that, you take the 155 share price, you divide it by the 641, you're going to end up with a PE ratio of 24.3 versus the 26.3 that came about on our original calculation. Now, Pepsi is a pretty steady company with steady revenues, and so you didn't see a huge gap in the forward versus the trailing. But that's not always the case. In a recent video we did on this channel regarding monthly dividend income, we looked at a company called Realty Income Corp, and the ticker for that is O, and it trades on the US exchange. A very astute, very alert viewer didn't just say, oh, I'm going to go buy that. Obviously, she was doing her due diligence. And Nazifa, he left a comment, the PE of Realty Income is 73. How could that be okay? And that's a very legitimate question, because she was saying this seems like a high price to earnings ratio. Is there something I should be aware of? Let's look at a chart for this company now that shows the two PE ratios. One is for the last 12 months, or the trailing 12 months, which is currently at 72.2. And let's compare that to the PE ratio for the next 12 months, or the forward PE of 46.5. And in this case, unlike Pepsi, you see a significant difference in those two ratios. So which one do you use? Let's look back at the earnings of Realty Income over the last 5 years or so. One of the things that you're going to notice is that the earnings per share on a quarterly basis came in pretty consistently between the 25 cents and 35 cents range. You will also notice there's a quarter that just stands out here, which was 7 cents per share. So the earnings dropped from that higher range down to 7 cents per share. If I zoom into that period, you're going to see the earnings per share went from 31 cents down to 7, back up to 33, 26, and then 33 in the most recent period. Now, just before those earnings were reported, you look at the trailing and the forward PE ratios were essentially the same. As soon as those numbers came out, which shows that drop in income, you'll see this big divergence. The orange line is the last 12 months, and the blue line is the next 12 months. So you can see how the last 12 months ratio went up significantly higher. This makes sense because it's based on reported numbers. So that 7 cent month or quarter had to be included in that calculation. That makes the price look that much higher. However, a lot of astute investors looked at this and said, how long is this going to last? Is it a one-time blip, or is this something that, there's a fundamental material change in the company? And as you can see by the blue line, as it goes forward, the forward PE ratio numbers remained at a much lower level. We'll see a blip again when the company reported at the end of March of this year. Exact same thing. Net income was reported lower. The last 12 months went higher because now it had both of those last reporting periods in there, and the next 12 months were expected. The analysts, the people doing the number crunching, suspected that this is not going to continue. Things seem to be somewhat back to normal, and as you can see by the price chart, the price change over the last year, they have been the people who didn't panic and the people who didn't just see that high PE ratio and run for the hills were able to capitalize on the growth there. I think using Pepsi and Realty Income are a couple of pretty good examples of how you actually take that number, do the math on it, but then apply it to real life situations, because it's not always as straightforward as it seems. I mentioned earlier that a PE ratio is what's called a relative valuation. And it is relative to both the current situation the company sees themselves, but it's also very, very useful at looking at how it compares against past benchmarks. A PE ratio can be used to analyze a company against a specific sector that it operates in. It can be used against its own history to see how it's doing compared to how it normally does. And it can also be used directly against some peers that you might be considering, stock A or stock B, maybe bank A, bank B. Let's look at a couple of examples of how you would apply it in a case like this. I'm going to start by using the company Merck, which of course is a large pharmaceutical company based out of the US. And if we look at the price to earnings gap for the trailing 12 months, so this is looking backwards, you're going to see that they are currently trading at a price to earnings ratio of 31.14. So first of all, let's compare that against the sector. We can see that the sector median is currently 35.62. You might say then in isolation, well, this appears that this company is undervalued compared to its peers, and in isolation that would probably be accurate. Let's now look at to sort of further the discussion. Let's look at how we can use that PE ratio to compare where Merck is today to where they normally are. So again, looking at the chart, we see they're at 31.14 today. When we look at their 5-year average of 42.2, this shows us that it sort of highlights that they are trading, I would say, significantly. I mean, they're trading 26% under their normal 5-year range. If I'm looking at this as an investor and I'm looking to see, should I be picking up some shares of Merck, all else being equal, I see this as a real signal that this company would warrant some further look. Now, let's take it to the next level and say we've decided we do want to invest in the pharmaceutical space, and we're trying to decide between Merck and one of their big competitors, Pfizer. I'm going to put Pfizer's information on the screen here at the same time. Going back to where we started, the PE gap for the trailing 12 months for Merck is 31.14. Pfizer, do the math, is currently trading is currently valued at 21.09. In isolation, again, if you're looking here, you would say, wow, it seems like Pfizer is in fact undervalued relative to Merck. Looking at the next metric here, you look at Pfizer compared to their 5-year longer term average. Well, they're trading 21.09 as a metric right now. Their price to earnings ratio over a 5-year average is 19.65. So they're actually currently around 7% higher than what they normally trade at. That adds another element of almost confusion, or adds to the picture here, because even though they are trading under the value that Merck is, they are trading over where they normally are. You could use this PE ratio to say Merck certainly seems to have more upside potential than Pfizer does right now, based on their own track history. So this is another example of how you can use the price earnings ratio to compare relative to a company itself, compare it to a sector, or compare it to one of its competitors or one of its peers when you're making your investment decisions. Let's move on now to the advantages and disadvantages of using the PE ratio. First of all, the advantages. The biggest advantage, I think, of using the PE ratio is it's quick, it's easy. I use it all the time for my first level of screening. If you're trying to find the PE ratio, it's very easy to calculate. You take the price divided by the earnings per share, you're done there. But pretty much every investment site that you're going to look at, if you look up a stock quote, most pages are going to have that PE ratio right on the front screen. Now, it's important to be aware the vast majority do report the trailing 12 months as opposed to the forward PE ratio. As long as you understand that, you can use that tool effectively. Very, very simple to compute. Also, it's very easy, as we just looked at, to compare it to other companies. So it's an easy flat number that you can use for your valuation comparisons right out of the gate. Those are kind of the advantages of the PE ratio. It also has a number of limitations. Like all ratios, number one, it can't be used in isolation. If you look at a price to earnings ratio and you see it's low, it's an indicator that it may be undervalued, but you just can't simply go out and make a purchase based on that, because there may be other factors. For example, the fact that a PE ratio is low, maybe the market has picked up on something. Maybe there's some trouble brewing in the company, and so you're going to want to make sure you dive deeper than just simply going low PE equals value. It doesn't. If a company is showing a high price to earnings ratio, does that mean the company is overvalued? Typically, that's one of the first things that come to mind, especially if it's way out of the range of its competitors. It may be a signal that you don't want to get involved in this company. However, not always the case. There are circumstances that you need to dig a little deeper and say a high price to earnings ratio might be justified given other factors. One of the factors is we mentioned earlier is the growth of the earnings. So and this is maybe a good chance for you to add to if you haven't already commented or left your vote on what the next video should be. The PEG ratio, the price to earnings to growth, factors in the growth as well, and it may be used to justify a higher price to earnings ratio. Not always the case. Another limitation, because you have a numerator and a denominator in this calculation, if you don't have a denominator, you can't do the calculation. An example of that would be if there's no earnings. There's no earnings number, and that would be the case, for example, on an IPO. So if a company has just initially gone public, they haven't reported publicly yet, you're going to have the numerator, you're going to know the share price, but you're not going to be able to do the math to calculate what the earnings per share would be, because there aren't any yet. Another very common challenge you have in a PE ratio is when the company has losses. You're going to have a negative number, and technically you can have a negative price to earnings ratio. It's very commonly not used. Usually if you have a negative ratio, so a company has lost in a quarter or in a year, and you do the price divided by a negative number, it's just going to show NA or zero. We're going to look at an example of that just in a moment here. So that's a limitation, because you're not going to be able to see what that number is. That said, the fact that a company is losing money, of course, doesn't mean that it is necessarily a bad investment. It's often the case, but we're going to use Amazon as an example here of a company that for years and years lost money. However, we all know how they're doing now. Let's look at this chart that shows a period of about 5 years from 2012 through to 2017. And you can see on the bottom part of this chart, for most of those most of those years, the earnings were either very, very low or they were operating at a loss. And because of this, if you look at the orange line, which is the trailing 12-month price to earnings ratio, you will see a huge gap in there from around middle to late 2012 right through till early 2016, with the exception of a very little blip there. Because they were losing money, that PE ratio wasn't being reported, and you weren't able to get that number to do your evaluation. Now, we all know how this story ends, and if we expand that time frame out to a 10-year chart, you're going to see, obviously, on the bottom part in the green bars, as the net earnings started to grow and grow and grow, you saw a couple of things. You saw the orange line. You saw that price to earnings ratio go from in the 400 range down to around 57.5 today. That makes sense. Earnings were going up. You'll also notice, of course, a significant increase in the price of Amazon. So this is sort of one of those examples of how the fact that there's it's a limitation of the price to earnings ratio. It doesn't mean that you can't actually use it. I think I touched on this earlier, but another thing that comes to mind is just the reliability of the numbers that you're using is a limitation. Trailing 12 months, you're relying on the reporting of the company itself. And our standards are pretty good, but the companies can manipulate those numbers. Or, of course, if you're using a forward price to earnings ratio and you're using the company's guidance, that can be somewhat misleading. You're trusting what they're having to say. You're relying on the estimates of analysts. So there's nothing written yet. It's just a projection, but it's a very, very commonly used, the forward earnings. So there are limitations just to be aware of. They both work, but just be careful with those numbers as well. I want to talk now about some traps, I would call them. And these are common things that people sort of fall into when they're using price to earnings ratios in their analysis. I want to look at how to spot them and how to defend yourself against them. The first and sort of most commonly used term is called a value trap. And this is when people see that low PE for all the reasons we just spoke about and jump on an opportunity because they feel that there must be good value in a company that has such a low PE. Low PE does not equal value. You have to do your due diligence beyond this. I use it as a screening method, but you can't just look at that and take a position in a stock. You have to look for things that may be wrong that are causing legitimately that number to be low. So that's one of the traps people fall into, is making a decision too quickly without doing their proper due diligence. The flip side to a value trap would be what I would call a growth trap. And the trap here is you look at a company with a high price to earnings ratio and you disregard it because it doesn't make sense. It looks like it's way overvalued. But if you look at the growth of a company, it may justify that number as long as the growth is strong and consistent. I'm just going to use Tesla as an example today. If we look at this chart, you'll see that the growth rate for Tesla in the last 5 years has been 31.25% compounding growth. They've recently traded with a price to earnings ratio in the 200 range, which by most estimates is far too high. You'll see that has come down to about 112 now that the earnings are starting to be reflected. So that's a normal cycle that you're going to see in a company like this, which is a new company growing. You're going to see some uncertainty, I would say. Now, if this growth rate is not sustained, then you may have a problem because that number is going to start creeping up again. But it is something to be aware of, that you don't just automatically write off a high PE company because there may be reasons to justify that. The next item to be aware of, I don't really know if it's a trap or not, but if a company is big on buying back their shares, when you buy back shares, you have fewer of them. So $1 of earnings is going to be divided by fewer shares. So the earnings per share is going to go up. You may have a situation where you have no fundamental change to the company whatsoever. Let's say that's neutral, but with fewer shares, you're going to have that earnings per share go up. That's going to produce mathematically a lower price to earnings ratio. So not the end of the world, but it's something that that you should be aware of when you're looking a little bit deeper to make sure that there's something more than just stock buybacks. It doesn't necessarily mean that the company is doing better or actually earning more profit per share. A couple more of the misses. Be aware that industries vary widely. So when you're making a comparison between two companies, You have to be aware of what industries they operate in. And if I just use the examples I used earlier of Pfizer and Realty Income Corporation, you'll see that Pfizer is trading with a PE of around 11 right now, and Realty Income Corporation is trading at a PE of around 47. So if you looked at this in isolation, you could think that Pfizer is way cheaper than Realty Income. However, understanding what you know now, if you look at compare against their peers, if you compared Pfizer to a Merck or Eli Lilly, that type of company, you're going to see a much narrower band that they operate in as far as the PE ratio is concerned. Conversely, if you compare Realty Income to other REITs, you're going to see typically they're trading with a much higher price to earnings ratio for a number of other reasons, quite notably because of the way that their accounting works. So they have a large amount of depreciation, amortization on their books. So that's going to artificially lower their price, their earnings per share rather, and that's going to result in a higher PE. You're going to see that on a regular basis. Be careful of that trap. A peak earnings trap is another thing. Under the best conditions, a lot of companies have periods of time where they have large income, large cash flows, large earnings per share. And most astute investors are going to pick up on this, but it's not unheard of that investors would look at a PE that has dropped because earnings have gone up in a period of time and consider that to be undervalued. And probably a vivid example of that would be a company like H&R Block, who of course are very seasonal. And when you look at their earnings per share on a quarterly basis, year in, year out, they lose money for 3 quarters, then they make all of their money, of course, during tax time. Their income is very, very lumpy, and so you're going to see that PE ratio move quite dramatically, especially on the trailing version of the calculation. Hopefully not so much on the future, but on the trailing, you're certainly going to see a lot of volatility there, something to be aware of. Lastly, for the purposes of what we're talking about today, major events that a company, an announcement, a purchase, a mergers, etc., can affect the price to earnings ratio quite dramatically. And we have to keep in mind that earnings are recorded quarterly, whereas prices are every day or every second of every day that the markets are open. So you're going to see that calculation at any given point in time be misleading. And I'm going to look at Moderna as the example I'll use here today. And if we look at their chart over the last couple of years, prior to the COVID-19 pandemic, Moderna didn't make any money. They lost money quarter after quarter. But of course, with their vaccine, they've all of a sudden become very profitable. And you see a very steep increase in their profit from losses up to currently just under $7 per share. Looking at their price to earnings ratio, when the data were there to actually calculate that number, it was around 320 or so when we look back to late last year. As their earnings have been come into the calculation, you're going to see that number go right down to a current ratio of approximately 9, or about 8.5 price to earnings ratio. Now, does this mean that a company is very, very cheap because they went from 300 down to 9 on the price earnings? That is a trap just waiting to be set. Not that Moderna might not continue with those numbers, but certainly those are very, very skewed because of the exceptional circumstances. They have yet to prove that going forward, they're going to be able to continue to earn those profits. And time will tell on that. Obviously, a company like this, there's a lot more that needs to be done to analyze whether you're going to put your money into it or not than just looking simply at that price to earnings ratio, which in a case like this, the special circumstances can be very misleading. Let me summarize. I think the price to earnings ratio can be a very, very valuable ratio, one of the most commonly used, most important ratios that we look at, but certainly for all the reasons we've discussed today, it's not 100% accurate. You have to combine this with many other ratios that are many other metrics or many other ways of looking at a company before you make a decision on buying or selling. This is a very good tool, but it certainly isn't a silver bullet because there just aren't any of those out there. For this video, last chance to vote, price earnings to growth for the next video or price to book for the next video. Both very important metrics, important ratios. I will add up your votes and make the next ratio video based on that. If you feel this is something, this type of information that, because the PE ratio is so widely used, it's also very widely misused. If you know anybody who is an investor you feel might be able to benefit from this video, feel free to forward it to them. I really would appreciate that, and spread the word. Lastly, as I mentioned earlier in the video, beneath I have the link to Koifin. If you're interested in learning more about the Koifin platform and how you can chart and analyze your companies, feel free to check that out below. And our Investing Academy, the first link down below, has an link for that. And we'd love to have you join. We're adding to the features of the Academy literally on a monthly basis, and just adding value to our students. So we'd love to have you check that out as well. I will wrap up this video. It's been a pleasure, and I look forward to seeing you in the next video.